Assalamu alaikum. This is Dr. Mahmoud Atifi. In this video, I am going to discuss one of the most important non-banking financial services, that is equity promoting and underwriting. To understand this topic, we should introduce to the final objective of these services, that is listing on stock exchange. Many companies are listed on stock exchange where their shares are traded and at market price, that is, are determined by demand and supply of investors. The company can benefit from having market price for its shares to issue more shares to raise needed capital and to compare the company with its peers and to use company shares as incentives for managers and facilitate merger and acquisitions transactions. So, for a private company to be listed and traded as a public company, it must sell some shares to public investors in a process called initial public offering or IPO. Because this process is complex and to avoid failure in selling shares at fair price on one hand, and on the other hand, this process involves legal procedures, pricing, and marketing, and allocations of shares. The issuing company needs advisors who specialize in providing equity promoting and underwriting services. So, in this lecture, we are going to discuss these services by defining what is meant by equity promoting and underwriting. Then we can who can provide this type of services and how can these services be conducted and how much these services charge. First of all, what is meant by equity promoting and underwriting? We can split this title into three words. First one is equity, which reflects the ownership and represented in the form of common shares. The second word is promoting, which means doing the best effort. So equity promoting means doing the best effort to sell the company's stocks to investors. While the third one is underwriting, that refers to guarantee to do something. So equity underwriting refers to guarantee to sell all or some of the company's common stocks to investors. So that we can say that equity underwriting and equity promoting and underwriting are two types of services to help a company sell its common stocks to investors. But who can provide this type of services? Actually, this type of services is the core business of investment bank, which is financial intermediary specializes in providing financial advisory services such as selling securities and merger and acquisitions transactions. But it doesn't provide commercial banking services such as giving loans or taking deposits. Examples of most famous investment banking firms in Egypt are EFG Hermes, CI Capital, Prime Holding, HC, Faros, and others. The structure of investment bank is designed to conduct these services efficiently because investment bank is divided into sell side and buy side. In sell side division, the investment bank has industry experts who can assist companies to determine number of shares to be offered, estimate its stock value, and select good timing to sell its shares. While in the buy side division, the investment bank includes financial analysts who have good connections with investors so they can help in marketing and the sale of companies' shares. In short, investment bank could advise on the offering, structure, pricing, timing, marketing for selling the company's shares in the IPO, as we will explain in the next slides. The equity promoting and underwriting services in the IPO process can be summarized as follows. Once the issuing company hired investment bank, who will discuss the offering structure, including to issue new or to sell existing shares or both, to specify the type of investors or not, to include international investors or not. Then the investment bank will form a team to conduct the due diligence and to estimate the stock price and to fill the IPO documents. The offering process starts with receiving buy orders from the potential investors, and accordingly the investment bank can set the final offering price, and finally it will allocate shares to new shareholders. After listing shares on the Egyptian Stock Exchange, the investment bank could provide price support if it is needed. So, if they issue new shares or to sell existing shares, these decisions reflect the main objective of the company to go public. So, if the company wants to fund business expansion, it will sell new shares or issue new shares to investors, and the proceeds or the cash flow from this IPO will be used for expansion. The process of issuing new shares in the IPO is known as primary offering. While if the founders of the company want to sell all or part of their ownership in this company, they will sell existing shares to public investors, and the proceeds of this sale will be received by those founders. This process of selling existing shares called secondary offering. So IPO is a way to get cash from the company and also from also for the shareholders. And many IPOs are a combination of primary and secondary offerings. Let me show you a simple example. If one company wants to go public to sell new shares to fund the business expansion, so this company will issue new shares of 2 million or equals 2 million shares. And at the same time, one of its existing owners want to exploit this IPO as exit strategy to sell his stake in this company by offering 30 million shares. The required is to calculate the value of each offering type and total IPO proceeds. If the stock price is estimated to be 5 Egyptian pound for each share. Actually, selling or issuing new shares equals 2 million shares refers to primary offering. So value of primary offering will be 2 million shares times 5 Egyptian pound per share. We will get 10 million Egyptian pounds. While issuing 30 million shares of the existing shares, it refers to secondary offering. So the secondary offering will be 30 million shares times 5 Egyptian pound per share. We will get 150 million Egyptian pounds. Thus, Total IPO proceeds will be the summation of primary offering and secondary offering proceeds, that is 10 million Egyptian pounds plus 150 million Egyptian pounds. We will get total proceeds of 160 million Egyptian pounds. Real examples from Egyptian IPO market regarding the types of offering involved or included in the IPOs. Most recent Egyptian IPOs such as Talim Services Company that went public by issuing 49 of the issued capital, specifically 358 million shares from its existing or its issued capital, and Fowry sold 36% of its existing shares, and CI Capital and Ubur. So in recent years, Egyptian IPOs include the secondary selling of the ordinary shares. This reflects the main incentive or the main objective of going public to use the IPO as exit strategy for the initial shareholders or existing shareholders or the founders of the company, and to increase the ownership base by joining new investors, either institutional investors or retail investors. The second element in the offering structure is to specify to whom shares will be offered, institutions or individuals. Actually, many companies want to avoid ownership dilution by selling a large percentage of the existing shares in a private offering, where the issuing company will specify certain financial institutions, such as banks, insurance companies, or pension funds, known as institutional investors tranche. And on the other hand, the company will decide to sell a smaller percentage of its ownership in a public offering to individual investors, known as retail investors tranche. Eye on the Egyptian IPO market. This table presents the offering structure of most recent Egyptian IPOs. We observe that they are classified into retail and institutional tranches, and the percentage of the institutional tranche is greater across all IPOs. Another eye on the Egyptian IPO market. In the IPO, the issuing company could specify a percentage of the offered shares to be directed to foreign institutions in what is called international offering. For example, the most recent IPO in Egypt was conducted by Talim Company, which directed 11 million shares to Egyptian retail tranche and 34 million shares to the foreign institutions, or what is called international offering. And another example of IPO conducted by RIMDA, which offered domestic offering of 20 million shares to Egyptian retail investors and initial offering of 357 million shares to foreign institutions. After the company contracted with the investment bank will form the IPO team to include lawyer, financial advisor, and auditor, in addition to representatives from the company management. This IPO team starts meetings to investigate and revise all the company's statements, reports, and legal issues in a process called due diligence. When the company management presents all information related to business operations, growth potentials, and so on, in what is called business due diligence. And also, lawyers will revise and address all major or any major litigations, revise contracts and the company licenses. While in the financial diligence, the auditor will revise all the financial statements. The main role of financial advisor is to prepare the fair value study, in which he will estimate the fair value of the company's shares, so that the due diligence process is to ensure the soundness, the accuracy, completion of information included in the IPO documents. So, what is the main IPO document? The main IPO document is the prospectus or public subscription note, which contains information such as company overview, management team, ownership structure, offering structure, the use of proceeds or the cash flow, a preliminary offering price, financial performance, risks, and growth opportunities. This is an example of IPO prospectus. So this is the first page of Fowry IPO prospectus, in which uh, members of the IPO team who are responsible for all information included in the Fowry prospectus. In the second part of this lecture, we will introduce a mini case about IPO pricing and allocation of shares. So, how can the investment bank set the final offering price or the stock price? Let me explain this by giving a simple example. Say one company wants to go public by selling 5,000 shares. The financial advisor used two valuation techniques to estimate the stock price to be 10 Egyptian pounds to 12 Egyptian pounds. So the investment bank has two options to set the final stock price and start receiving buy orders from the potential investors. The first option is to set the fixed price, say 11 Egyptian pounds per share, or to use a price range of 10 to 12 Egyptian pounds and announce this range to investors to submit their bids, in which each investor will specify the number of shares and share price he or she is willing to pay. After receiving the buy orders, the investment bank has two methods or mechanisms: the book building mechanism and auction mechanism, that can be used by the investment bank to find the final offering price and calculate the IPO proceeds and calculate the number of shares received by each investor. If the investment bank received five purchase orders from five potential investors, in each order the investor will determine how many shares he wants to buy and at which price. For example, investor A requested 3,000 shares and he is willing to pay 10 Egyptian pounds per share, while investor D wants to buy only 1,000 shares and he is willing to pay 12 Egyptian pounds per share. Okay, suppose that the investment bank wants to price the final offering price for each stock using the book building mechanism to sell 5,000 shares to 5 investors. So the first step in the book building mechanism is to build a book of orders and calculate the value of each order simply by multiplying the number of shares times the share price specified in the order. So the market value of the first order, which is received from a bidder or the buyer 1, buyer A, will be 30,000 Egyptian pounds. And the market value of orders received from investor C will be 18,000 Egyptian pounds, which equals 1,500 shares times 12 Egyptian pounds, and so on. So at the end of the subscriptions period or at the closing date, the investment bank simply submissions the number of shares, total number of shares requested by all the 5 investors, and sum up all the total value of all orders requested by all 5 investors. Why? To ensure that the number of shares requested will cover the number of shares offered by the company. In our case, the total number of shares requested by the 5 investors is 10,000 shares, while the company wants to sell 5,000 shares. So it is good news for the investment bank and for the company, and this IPO seems to be successful. So the second step is to find the final stock price at which the shares will be allocated to investors. In the book building method, the final stock price will be calculated by dividing the total value of orders requested divided by the total number of shares requested. So we will divide 109,500 Egyptian pounds divided by 10,000 shares, which is the total number of shares requested. So the final offering price will be 10.95 Egyptian pounds per share. So each investor will pay 10.95 Egyptian pounds for buying each share. But how many shares will be allocated to each investor? Will investor A, for example, receive all the 3,000 shares requested in his order, and so on for investor B and C and D and investor E? Actually, to identify how many shares will be allocated for each investor, we want to calculate what is called coverage ratio. In our case, the total number of shares requested is 10,000, while the company will sell only 5,000. This means that this issue is called oversubscribed. Oversubscribed indicates that the number of shares requested is greater than the number of shares offered. By how many times? Actually, by 2 times. This is a coverage ratio. How we can calculate the coverage ratio? Simply, you can divide the total number of shares requested by the total number of shares offered. So 10,000 shares divided by 5,000 shares equals 2 times. This means this issue is covered 2 times by the investors. So this is a rationale that the each investor will not receive total number of shares offered or requested in his order. So he will receive a percentage of what he or she requested. This percentage is called pro rata basis. How we can calculate pro rata basis is reciprocal calculations of the coverage ratio. So we will divide the total number of shares offered by the company divided by the total number of shares requested by the investors. So we will divide 5,000 over 10,000 shares, we will get 0.5, which means that in each investor will receive 50% of what he or she requested. For example, investor A, he requested 3,000 shares, but because this issue is oversubscribed, he will receive only 50% of what he requested. So 3,000 times the percentage of 0.5 equals 1,500 shares. And investor P will receive 1,000 shares. However, he requested 2,000 shares, but this issue is oversubscribed, so he will receive 50% of what he requested. And for investor C, he requested 1,500 shares, but he will receive 50%, so 1,500 shares times 0.5 will result in 750 shares. And for investor D, he requested 1,000 shares, but he will receive 50% of what he requested, so he will receive only 500 shares. And for investor E, he requested 2,500 shares times 0.5, so he will receive 1,250 shares. Okay, the final step is to calculate the total IPO proceeds or the cash flow from the IPO. So the summations of all shares requested must equal the total number of shares offered by the company. So if the company sell 5,000 shares at 2.95, so the company can raise 54,750 Egyptian pounds. So the IPO proceeds can be obtained by multiplying the number of shares offered by the company and the final offering price, which is 10.95. So the company actually raised 54,750 Egyptian pounds from this IPO. Second mechanism through which the investment bank can price the stock value in the IPO and allocate the shares to the investors is the auction method or auction mechanism. Given that we have 5 orders already submitted by 5 investors, in each order the investor specify how many shares he or she wants to buy and at which price. In the auction mechanism, the investment bank wants to sell the 5,000 shares, and he received 5 purchase orders. So the first step is to arrange these orders descending according to the price demanded by those investors. So the highest price is 12. The highest price is 12, and so we have two requests or two purchase orders received from two investors who want to buy shares at the highest price. The lowest price is 10. Price limit, the smallest price limit is 10. We have only one purchase order from investor A who wants to buy 3,000 shares at 10 Egyptian pounds. So the first step is to arrange descending according to the price level. So we will arrange the orders according to the price from the highest to and move down to the lowest price. The second step is to calculate what is called cumulative shares at each price level, which means at the price level 12 Egyptian pounds, we have two orders, 1,500 shares and 1,000 shares. So this means the total number of shares requested at the price 12 Egyptian pounds will be 2,500 shares. But if the investment bank decides to set the final offering price at 12 Egyptian pounds, he can only sell 2,500 shares. But the company wants to sell 5,000 shares. So the investment bank must decrease the price per share from 12 to 11. So he will try to decrease the price from 12 to 11 to increase the number of shares he could sell. So at price level 11, he could or he have two requests, 2,000 shares and 2,500 shares, which equals 4,500 shares. But if he decreased the price from 12 to 11, he could sell 2,500 shares, which is requested already at a higher price, and more 4,500 shares, which already requested at the price level of 11 Egyptian pounds. So if the bank decreased the price from 12 to 11, he could sell 7,000 shares. But the company wants to sell only 5,000 shares. This means that not all shares requested by each investor will be received. We will use the pro rata basis to allocate the shares. But at this step, we want to set the final offering price. The final offering price will be 11 Egyptian pounds. So why this is the best price? Because at 11 Egyptian pounds, then the investment bank can sell the 5,000 shares. So the best price will be 11, or the final price will be 11 Egyptian pounds. This means that investor A, who already sent or submit order specifying 10 Egyptian pounds, which is the smallest limit in the price range, will not receive any shares. So investor C, D, B, E are called winning investors because they demand to buy shares at a higher price. But all those investors will pay the uniform clearing price, which is 11 Egyptian pounds. But how many shares received by each investor? We said before the total number of shares requested is 7,000 shares, but the company wants to sell 5,000 shares. So we will use a pro rata basis by dividing the number of shares offered over the number of shares requested. So the ratio will be 0.71 or 71%, which means that each investor or each winning investor will receive only 71% of what he or she requested. So we can we can use this ratio to find how many shares will be allocated for each investor. Investor C already requested 1,500 shares, but he will receive 71%. So 1,500 shares times 0.71 equals 1,071 shares. And by the same way, we can calculate how many shares will be received by investor D, who are requested 1,000, so he will receive 714 shares. Investor B will receive 1,428, and investor E will receive 1,785, which is calculated from multiplying 2,500 times 0.71. Of course, the summations of all shares allocated must equal 5,000 shares, which is the number of shares the company wants to sell. The final step is to calculate the IPO proceeds from this IPO by multiplying the number of shares times the final offering price. Final offering price is 11 times 5,000 shares will equal 55,000 Egyptian pounds. So the IPO proceeds or the cash flow from this IPO equal 55,000 Egyptian pounds. After conducting the allocation of shares to new shareholders and listing the company shares on the domestic stock exchange such as Egyptian Stock Exchange, the trading on the company can start. Actually, on the first trading day, the company and the investment bank are worried about stock price performance, reflecting demand and supply of the company shares. Why? Because the price performance reflects the efficiency of the investment bank in pricing the company shares. So in our simple example, if the offering price is 11 Egyptian pounds and the trading starts on the company shares when the price of shares closed at 13 Egyptian pounds per share on the first trading day. On one hand, this increase in stock price reflects high demand that is good news. On the other hand, the company management considers the increase in the price by 2 Egyptian pounds that the company managers left 2 Egyptian pounds per share on the table for the new shareholders. And the company managers say we could sell shares at 13 Egyptian pounds instead of 11 Egyptian pounds. So our shares are underpriced, and the company managers can calculate the underpricing cost and the difference between the close price of the first trading day, in our example is 13, and offering price that is 11 times number of shares offered that is 5,000 shares. So the underpricing cost is 13 minus 11 equals 2 Egyptian pounds times 5,000 shares. Well, we will get 10,000 Egyptian pounds. So underpricing cost is considered as indirect cost of a floating company on the stock exchange. We look at the performance of recent IPOs in Egypt as example. On the first trading day, most IPOs experience underpricing on the first trading day. For example, Ta'lim Management Services Company. The offering price was 5.75 Egyptian pounds, and the close price on the first trading day is 6.1. So the difference between the close price and the offering price is calculated in percent, 6.1%, which is calculated by this equations: close price on the first trading day minus offering price divided by offering price times 100. Emerald Real Estate Investment offered at 2.89 Egyptian pounds, and this price increased to 2.99 Egyptian pounds on the first trading day. We have exceptions for this phenomena, like Remeda and Sarwa Capital Holding, but we calculate based on the close price on the first trading day. Maybe during the trading sessions there was increase in the price from 4.66 to any price, but at the close price there is a decrease to 4.44. And the same thing for Sarwa Capital Holding. Maybe in the during the trading session there was increase in the price, but at the close price, or the close price was 3.91, which reflects decrease from the offering price. But underpricing is a phenomena in most stock exchanges around the world. So it is called phenomena, and there are several explanations why most IPOs in most stock exchanges experience underpricing in the first trading, calculated on the first trading day. Okay, does the investment bank perform any tasks in the secondary market? Secondary market is a stock exchange. Since the issuing company wants to avoid temporary drop in its share market price, it usually agrees with the investment bank to stabilize or support the price of any issued shares to keep it not selling below the offering price in the stock exchange for a relatively short-term period, for example 30 days. During this period, the investment bank is ready to buy any shares offered by the new shareholders in case the price of shares falls below the offering price. Are underwriting or promoting services free? Of course not. And the cost of or expenses for underwriting or promoting services depends on the agreement between the investment bank and the issuing company. Let me The fees paid to the investment banks depend on the underwriting agreement between the issuing company and the investment bank. So, if the investment bank agreed to underwrite the offering, so the underwriting agreement is known as firm commitment agreement, in which the investment bank guarantees to sell part or all shares offered by the company. So the investment bank bears the full risk of unsold shares, risk of not selling a certain number of shares. Why? Because the firm commitment agreement specifies that the investment bank would buy all shares from the company and then sell these shares to the investors at the offering price. in our example, the investment bank could buy the 5,000 shares at 10 Egyptian pounds and then sell these shares to the investors at 11 Egyptian pounds. So the profit or the revenue for the investment bank takes the form of spread. That is the difference between the price paid to the company and the price received from the investors. So the underwriting spread will be 11 minus 10 times 5,000 shares will be 5,000 Egyptian pounds because the spread is only 1 Egyptian pounds per share, and the number of shares will be underwritten by the investment bank is 5,000 shares. So the investment bank generated profits equals to 5,000 Egyptian pounds. But if the investment bank agreed to promote the IPO, provide equity promoting service, so the contract will be best effort agreement, by which the investment bank doesn't guarantee to sell any shares, so the investment bank doesn't bear any risk of unsold shares. And the investment bank will receive fees as a percentage of the IPO proceeds. Say if the investment bank agreed with the company to get 7% of the IPO proceeds as underwriting fees. So the underwriting fees in our example will be 7% times the IPO proceeds. IPO proceeds calculated by the multiplications between 5,000 shares times 11, which is the offering price. So 55,000 Egyptian pounds. So the investment bank will get 7% of the 55,000 Egyptian pounds. So the underwriting fees will be 3,850 Egyptian pounds. At the end, we can summarize what we discussed in this video. The company wants to sell shares to investors, so it needs to hire investment bank for advising about structure and the timing of the offering, managing the IPO team and the process, marketing for the issue through presentations, especially for institutional investors, and selecting pricing mechanism to price and allocate shares. And we have three different pricing mechanisms: fixed price mechanism and book building and auction. After listing shares on the stock exchange, the investment bank provide aftermarket price support for a specific period of time, normally as 30 days. And at the end, we discussed the underwriting fees, which depends significantly on the underwriting agreement, either best effort agreement or firm commitment agreement. Thank you and good luck.